Well, hello everyone, and good evening. And this is a slightly different way of doing things than I usually do it. I mean, normally what happens is that we have a Q&A, and really you can just fire any question you want at me. What we're doing this time is slightly different because what we're going to do is I'll speak initially. So I'll go through a kind of presentation talking about the commodity supercycle story, just introducing the concepts, and then I'll leave it open to questions at the end. And also, could he keep the questions focused on that very topic? So just on the commodity supercycle rather than general investment questions. So please hold back the questions until I finish. And I'm going to be talking for about 15 minutes. I will try and keep it snappy and concise. So if we could keep it to that kind of format, that would be great. And I'll also try to answer any questions from people who've supported us by joining us on YouTube, or anyone who super chats first once we go into the Q&A. Now, unfortunately, with YouTube Live, I don't think you can switch off the questions initially. So it'll seem as if you can ask a question, but you can't. Okay. That's a slightly odd situation. Okay, so I realise that some people join late, so I'll give it just 1 minute for some more people to join us, and then I'll launch into it. Okay. Right. So let's see how we're doing. Okay. See how many people we've got now. Okay, we've got 144 people, so I'll get started now. So just to recap, don't ask any questions till I finish speaking. So that'll be about 15 minutes. So just give me a chance to say my thing, and then we'll launch into the questions. So let me switch to Prezo. Okay, so I'll give the usual disclaimer. This is not a recommendation. So I'm not saying you should buy any particular asset or you should go out there and buy commodities. And if you really do find this interesting, then to see whether it's suitable, you could always ask a financial advisor to see if it is suitable for you. So this is not promoting any particular product or any particular platform or service or particular commodity. So if you do find this interesting, why not go out and do your own research? Just see this as a kind of starter to help you go and investigate this stuff yourself. And as always, screen where I got the information from. So you can go out and research it yourself. There'll be a source at the bottom of each page where I've taken it from some third party. Okay, so let's start off by looking at what we mean by a supercycle. Now, this is just for the oil price, so the price of oil in dollars, and this goes back over a century. And what you can see here is a kind of filtered oil price. And this is the real oil price, the big black line here at the top, which is very wiggly. Now notice that it's extremely volatile. It moves up and down a lot. So if you do smooth it out, what you get is the kind of trend price, the slowly varying trend price of oil in real terms. In other words, once you incorporate the effect of inflation. Now, what you can also do is detrend the data. So if you do that, what you're left with are the kind of wiggles around the trend. And that are kind of decade-long variations up and down in the oil price, which is what you can see here with a kind of a longer dashed line. So when you're thinking about a super cycle, what we're talking about is not the day-to-day fluctuation in price, that's just volatility. We're talking about a kind of long-term, decades-long, potentially, trend in the price of commodities. And usually there are some really big macroeconomic factors which drive these very slow trends. Now, typically that would be some kind of process whereby a country is building up its infrastructure. So it might be building it up for the first time. So this is the US Capitol building that you can see on the left-hand side here being built in America. And this was a time of a huge amount of activity in building in the US. So that required a lot of commodities. So you can actually see the metals going into some of these struts here, which were the kind of skeleton that they actually hung the superstructure on. And then this was the railway line in the US, which was finally built across the entire US. And this is when they actually joined the two lines from either side of the United States. So that was a huge infrastructure program which required a lot of iron, a lot of steel, and obviously the US had to buy that steel or make the steel itself. So that's been a very commodity intensive process whereby a country builds infrastructure for the first time. Or another example might be the reconstruction of Europe and Japan after the Second World War. Obviously, bombing destroyed a lot of cities and a lot of infrastructure, and that had to be rebuilt. And that was a very commodity intensive process, which drove commodity prices higher. So that was another decades-long trend following the Second World War. And another one, obviously, the one more recently that we're all aware of, this is Shanghai. And obviously it takes a lot of steel, a lot of copper, and a lot of resources to build all these beautiful buildings. So that's usually why you get these very long-term trends in commodities. It's to build this kind of infrastructure. Now, obviously at the moment, China is driving a lot of that demand. So in fact, for things like cement, steel, copper, coal, nickel, more than half of the world's supply of those commodities is currently going to China. So this is a lovely graph from Visual Capitalist, which is great. If you haven't looked at that website, do have a look. But you can see that China is currently very dominant, but obviously that wasn't the case even 10 years ago or 20 years ago. So what happens over time is that different countries will come to the fore in terms of their use of commodities and their commodity intensiveness of their growth. And at the moment, China is obviously the one which is absorbing a lot of the world's supply and driving prices. That's the important thing. And in fact, another proxy for growth in China is how copper prices are varying. Because if China is growing very quickly, that tends to push up the price of copper and other industrial metals, which they're very dependent on. So that might be a good proxy for a GDP in China, for example, a kind of cross-check to see whether their GDP numbers are plausible. Now, obviously, capital expenditure is what drives these commodity cycles as well. So why is that important? Well, it's kind of interesting that in 2000, when we had the dot-com bubble, a lot of money was being pumped into tech companies because they were just seen as having a greater upside. And we're in a very similar situation now where the tech companies like Google, Microsoft, Apple, Netflix, to a lesser extent Tesla, are driving equity markets because all of the capital, a lot of capital is flowing to those companies because they've been very successful in growing their sales. But of course, they don't depend hugely on commodities as other companies might. So, for example, transportation companies would depend heavily on fossil fuels, but Google and other tech companies aren't so heavily dependent on such commodities. So what happened in 2000 was that there was a lot less kind of physical infrastructure spending. There was less capex growth. And following the dot-com bubble's implosion, suddenly capital started flowing back into things like manufacturing, for example. And then capex growth picked up after that slump that we saw in the dot-com bubble. Then we had another slump, and you can see these very slow year-on-year changes of that capital, that kind of capex growth. Currently, obviously, because of the pandemic, this graph ends in 2019, and it was looking back to 2018. So you can see that 2019 was an estimate. But capital expenditure also was slow in 2019 because of the tech dominance that we're currently seeing. And of course, the pandemic made it that much worse. So as we come out of the pandemic, obviously, as we're expecting that growth will pick up, we're also expecting that more people will be getting out into their cars, companies will be transporting more goods and services, we'll see more travel with airlines, and generally the level of activity is going to pick up again. And that's going to increase the demand for commodities and also capital expenditure. So, I mean, a fairly obvious result of that is that we probably will see commodity prices increase. We've already seen it to some extent. So just looking forward to 2021, there's this nice pair of graphs from S&P Global, which looks at the effects in 2020 on of the pickup in activity through that year on various commodity prices. So liquid natural gas here you can see shot up. We also saw the price of oil increase, but things like iron ore also have picked up quite significantly in 2020. So the question, I guess the other question is what's going to happen to the dollar, because all commodities are priced in dollars. And if the dollar's weak, that pushes up commodity prices. And you can see a very clear negative relationship between the strength of the dollar and commodity prices. So commodity demand generally is inversely related to commodity prices. And, you know, what were the drivers in 2021 so far? Well, for oil, obviously OPEC has cut supply. There's been an increased use of transport, and there's been a big pickup in demand from China. But for every single one of these commodities, you can see that there's a different set of drivers. So, for example, for rice, there was a drought. So generally for agricultural commodities, there are these unpredictable factors like disease in animals or droughts for crops or the strength of particular currencies where the producers are based. So the Thai baht in this case for rice production. Or in the case of iron ore, obviously Brazil's a big producer. So if there are shortages, then that would push up the price of iron ore. And it's driven by Chinese demand, for example. And then for copper, obviously we've already seen that copper absorbs about half of global demand for copper. So while demand has been increasing, that's been a big driver of copper prices in 2021 so far. So this is a kind of short-term bounce that you'd expect to see. But that's not what we're going to focus on. What we're going to be thinking about is a super cycle. So in other words, an even longer trend which could last a decade. So is that going to happen? And if so, what's going to drive it? Now, so let me just recap in case some of you have just joined us. The reason why I'm just talking, not asking questions, allowing you to ask questions, is that this is slightly different from the usual format. I'm going to just present these ideas as a kind of help to you to do your own research on this topic. And then if you go away, you can figure out whether this kind of makes sense to you. And if you don't agree with me, I've also done my job, because I'll create your own ideas about what's going to happen to the super cycle. It's never my job to tell you what to think. I just want to be a kind of catalyst to help you come up with your own opinion. And I'd be quite happy if you disagree with me, in fact.
Just ask people to like it.
Yes, oh yes, and do like it. I should be saying that as well, yeah. Do like the stream because it helps us a lot. Let's just see how many people have liked it. I'll just flip back. We've had 79 likes so far. We've got 309 viewers. So usually at this point I'd have said, please like it. So do, please like it. That helps us a lot. So back to the scheduled program. And I will allow you to ask questions at the end, but please keep it to questions about commodities. Just hold back on the questions till I finish. Okay. Right, so the question is, are we entering a new super cycle now? Now, there's this beautiful graph which is shared by Ottavio Costa, where he's showing the private investments in mining exploration. So now a lot of these ideas come from the head of commodity strategy at Goldman Sachs. So I'll give you the references at the end so you can look these up for yourself. But one of the points he makes is that private investments in mining exploration have completely collapsed over the last 10, 20 years. Now, why is that? Well, certainly over the last decade, there's been this massive flow of capital into those tech companies. So there's less capital available for companies to do things like oil exploration or mining exploration. So if there's an undersupply as a result, because remember, if you run copper mines, eventually the copper mines will run out of copper. So you're always having to look for new sources. And if you stop looking or exploring for new sources, that eventually will lead to a restriction in supply. So that's why this essentially is potentially a bull case for commodities, because if there's less exploration and also less money spent on infrastructure to keep it up to scratch, then that could potentially restrict supply as demand increases, and obviously that pushes up prices. Higher demand, restricted supply is obviously the recipe for a kind of super cycle rise in commodity prices. Now, another big part of the story is politics. Now, I often talk about what happens with monetary policy, and the problem with monetary policy is that it affects everybody in society in exactly the same way. That's why, so for example, if you set the interest rate, if the Federal Reserve sets the interest rate or the Bank of England sets the interest rate, the same interest rate is for everybody in the country. Now, who does that benefit? Well, during this last decade, and in fact, this is a graph from 2006 to 2012, this shows you, according to the wealth of people in the UK, so these are the very wealthiest 10% of British people, and these are the very poorest on the far left. This shows you what the change in net wealth is as a result of quantitative easing. And what's very clear is that the vast majority of the benefits of quantitative easing and monetary policy over this decade have been for the very wealthiest in society. Why? Because they're the ones which hold the assets which have gained most due to low interest rates. So that's equity prices, that's bond prices, that's house prices. All of those have been hugely inflated by interest rates being at zero, but also the huge program of bond buying which we've seen. And the reason why that's a problem is the pattern of consumption which those very wealthy people have, as we'll see in a second. Now, what's really changed during the pandemic is fiscal stimulus. In other words, the government have moved away from this narrative of austerity, which we heard for a long time, and suddenly they've shown that when push comes to shove, they can issue money out of thin air. And has that been hugely inflationary? No, it hasn't. And it hasn't been over the last decade either. So theories like modern monetary theory, MMT, are becoming much more mainstream. And this fiscal stimulus is, I'd say, the biggest change in terms of how governments will fund things going forward. And a big part of the stimulus in order to get economies going again is going to be reconstruction. Some of this will be for green projects. That's certainly what Biden's been talking about, and also in the UK and in Europe. And if that's the case, then the question is, how's that going to feed into commodity prices and also into growth? But the key thing is that fiscal stimulus does benefit the poorest in society. So unlike this kind of graph where monetary policy favours the rich, fiscal stimulus actually benefits the poor. And the reason why that matters for commodities is really interesting. So here's Biden's policy, and he's talking about what he's going to do with the economy. And a big part of it is racial justice. So trying to destroy that, or kind of reduce the inequality between, for example, Black Americans and white Americans, but also Hispanics. but also trying to create millions of jobs by strengthening small businesses. Now, obviously, that's going to help the poorest in society because white-collar jobs essentially cruised through the pandemic without a lot of job losses because those people could still work from home. The people who've suffered the most have been the people who work in service jobs, who weren't able to work in those jobs anymore, and they tend to be lower paid. So the key point here is that if we have fiscal stimulus, in other words, checks put into people's hands, the propensity to consume, in other words, if you give $1 to someone who's in the bottom 10th percentile in the US, they'll usually go out and spend that 100% of that dollar. Whereas if you give it to the person who's in the top 10%, why would they go out and spend the dollar? So their propensity to spend, or their marginal propensity to consume, as economists call it, is much lower. So that's why this graph is kind of interesting. It shows you the change in income on the x-axis between 2005 and 2007, and on the y-axis you can see the change in consumption. Now obviously if you have more money, your income has gone up, you'll consume more. But what it shows is that for the bottom wealth quintile, which is the dashed red line and the red dots, the propensity to consume increases more. So that's why it's going to be hugely beneficial for the poorer parts of society if we depend more on fiscal stimulus. And the second part of the argument is what people spend their money on. Now what's interesting is, well, let me come back to that. This is like a typical, it's like a kind of caricature, I guess. But on the left here, I've got the kind of spending you'd expect from someone who's quite wealthy. So they might eat some red meat, but they also eat things like fish. But if you go for kind of down the socioeconomic scale in the US, they tend to spend more on red meat. For the guy on the left who's quite wealthy, maybe they've got a Tesla, which isn't very commodity intensive in terms of fossil fuels. The guy on the right can't afford a Tesla, maybe he's got a pickup truck, but that's going to use more commodities. The guy on the left has a beautifully insulated house, which is perhaps even energy neutral, passively heated, for example, whereas the guy on the right, who's got less money, is living in a less energy efficient house, which requires much more in terms of heating costs. So this is why if you give money to the people on the right, they're going to spend more on commodities. Their consumption is not just higher, but it's more commodity intensive. Whereas the people on the left generally will be less commodity intensive, because the fish is a nice example, because fish requires less in terms of land usage and in terms of water consumption. So a lot of these patterns of consumption matter a lot. So a move to fiscal stimulus, a different pattern of consumption where there'll be more marginal propensity to consume, and that pattern of consumption is going to be more commodity intensive. All of that is going to feed into a commodity supercycle, which will push up commodity prices. Now, another part of this story is dollar weakness. So that's something we've seen over the last several months. The dollar's weakened. As we've seen this extremely strong equity rally, the dollar has been steadily losing strength versus other major currencies. Now, this is kind of like the petrodollar recycling story that we saw in the 1970s, where the US has a greater commodity demand, which means that it spends on commodities. When the dollar, obviously you buy commodities with dollars, so you have to sell dollars to buy the commodities, and that weakens the dollar. That tends to put up the price of producing commodities, which usually happens in places like Chile for copper, for example. And if that weakens the dollar versus the Chilean peso, then the price of the Chilean peso increases, and that actually increases the local production costs in dollar terms of producing those commodities. Then they get a trade surplus, countries like Chile, for example, for copper, and they have to invest it somewhere. they might buy treasuries. That generates more dollars, which then get loaned out, and that increases spending on commodities again. What happens to those dollars? They get plowed back into commodities, as this increased demand for commodities is going to be driven by these kind of fiscal stimulus programs and the rebuilding programs and the programs to stimulate GDP. So this whole cycle kind of feeds on itself with a weakening dollar and rising commodity prices. And it would only be a slowdown in growth which would break this linkage. So that's why a weaker dollar is going to kind of feed into this cycle. So another thing is disruption of supply chains. So it seems as if Biden's policy is also going to be quite strict and quite aggressive against China. And so this is a recent speech. In fact, it was made, I think, about 3 days ago, by Biden, where he says we're going to confront China's economic abuses, counter its aggressive, coercive action, push back on their attack on human rights, intellectual property, and global governance. So obviously they see China as a competitor in technology, as they should, because it is. And there's going to be rebuilding of supply chains. I think what the pandemic showed is that supply chains are very fragile, and any kind of disruption could destroy or at least damage the economy in any country. And so if countries have to build their own supply chains, that itself will be a commodity intensive process, which should push up commodity prices. So these supply chain disruptions, building independent supply chains within each country, is going to be commodity intensive. So that's another bull case for commodities, I think. So let's say that you kind of buy into this argument that commodities are going to see a 10-year or even longer rise in value due to these factors that we've seen. How can you actually get exposure to these commodities? Well, exchange traded products offer a way to do that. And if you want to look these up, in the UK, we've got a website called Just ETF. And I'll put a link in the description of the video afterwards so you can click on this yourself. And this links all the exchange traded products which give you commodity exposure. They're usually labeled as ETCs, exchange traded commodity funds. And in the US, if you're listening from the US, ETFDB has an equivalent page. But let me just give you the quick description of how those work. Some of them are physical exchange traded products. So typically things like gold and silver, you can actually go out and buy silver and gold and store it in a fairly compact space. So if I was to fill this room, for example, with gold, I could probably store a lot of gold in terms of monetary value. If I wanted to fill this room with oil, I couldn't store so much, and it would be worth much less. I might get, 100 barrels of oil in this room, but I could get a huge amount of gold in terms of monetary value. So you can store precious metals safely, presumably, and that means you can have physically linked exchange traded products. So gold and silver typically will have a repository somewhere where if you buy some of the fund, they'll go out and put some gold in proportion to your purchase into a vault somewhere. And if you sell, they'll sell that gold. So that makes it really easy to link the price of the fund with the price of the physical commodity. With other commodities, it's not so easy. And gold is one example where you can store. Oil is an example where you can't store. And there, typically, you do it through the futures market. So they call those synthetic exchange-traded products. Now, the reason why the futures market is different is that you can't buy the actual oil. So what you do is you buy it in a futures market. So, for example, if you wanted to buy the first month futures contract, this would be a contract to buy oil at a fixed price at a fixed time in the future. But then when it actually came time for delivery, you'd roll into the next contract. But notice how if the curve's upward sloping, if you're selling this contract and buying this contract, you sell at a lower price than you buy, and you have to pay the roll cost. So if you've got an upward sloping futures curve, you're all continually having to pay away that roll cost if it's in contango. If the curve is somehow reversed, so short-term futures contracts are higher, then the roll cost becomes positive. So there you're actually benefiting from a big demand for physical delivery. In that case, that pushes up the short-term futures above long-term. So if there's a constrained supply, you get backwardation and you can actually make money out of the roll. But that's why it's more complicated buying oil ETFs than gold ETFs, because you have to think about the futures and which futures are being bought by the fund. So if you do buy these exchange traded products, you'll see some of them described as enhanced, or it'll say something about roll enhanced in the title of the fund. Now this is an example of that from WisdomTree, and you'll see at the bottom here it says, rather than selecting the new future based on a predefined schedule, e.g. monthly, so you don't just buy the next one that's going to expire or the one in 2 months, you actually choose a part of the futures curve which gives you the best possible outcome. Now in the case of a curve like this, it would choose them way out in the future where the slope is very flat, because then you get less roll cost. If it was in backwardation, you do the opposite. You'd go for the ones where the slope was steepest and falling as you go further into the future. And so that's how Wisdom, in order to enhance the income for you as an investor in the fund. So that's probably the best way to go for one of these commodities where you can't physically store it, where it has to be bought through the futures contracts. And typically that would be things you couldn't store. So energy we've already seen, but it may be that some of the other things like industrial metals are done through the futures market, or maybe the agricultural stuff like soybeans would also be done via the futures market. So that's just another thing to consider when you actually go out there and choose the funds. So let me stop there, because I realise I've been talking for half an hour. And let me get you to ask some questions. So please do. Oh yes, I should say the guy who came up with a lot of these ideas is Jeff Curry at Goldman Sachs. He's the strategist. He's the commodity strategist at Goldman Sachs. And there are 2 great articles which kind of summarize his views. One on Reuters here and one on Market Insider. So do have a look at those, or listen to the Odd Lot podcast with Tracy Alloway and Joe Weisenthal, who interviewed him this week. It was a really good podcast about it. And see what you make of this yourself. I'd be interested to hear your opinions, actually, which I suspect I'm about to. So let me switch back here and get rid of this, and we can start asking you some questions.
Just tell people to like while you're waiting.
Yes, please like the stream. It helps us a lot. If you like it, that would be great. I see we've got 466 viewers, only 201 likes, so please do like it. That would be great. And thank you to James Yo and Carla Hernandez, who've decided to support us on YouTube. That's great.
Can't cut them, they're going too quickly.
Okay.
If you move to the bottom, you'll get them.
Okay. Right.
I'm going to do it to you. Got one.
Are these?
Got a question.
Okay. So Rushar, nice to hear from you again. A lot of mining stocks have increased significantly in the past year. I'm holding something that has more than doubled. Would you say this increase is going to continue? Well, I'm not sure exactly which mining stock you're talking about, but obviously that's the other way to get exposure to this market is via the stocks of the companies which do the mining. The difficulty there is if you are going to go for the single stock option, if you're going to go for the single stock way of doing things, is that there may be idiosyncratic risk for that particular stock, which means that if they have just a couple of very large mines and there's some kind of industrial dispute at the mine, it could dent their earnings quite significantly. So it might be better to go for an entire sector fund, which buys an entire energy sector or a particular renewable energy sector, perhaps, or copper or gold mining companies, for example. I know there are funds for all of those. So I'd probably try and reduce my risk by doing that. Also, you don't have to kind of worry at night about a particular mine having a strike, for example. But if this is a long-term trend that you're buying into, as long as you buy the stock and hold it for a very long time, then probably you'll be okay. Also, the danger is that in the energy sector, for example, there's going to be a lot of consolidation. Not all of the energy companies are going to make it, and you may be unlucky in the one that you choose. And of course, with equity, you can make 100% loss if the company becomes bankrupt. If it's taken over, obviously, that's not a problem. But that's probably something to consider. I should have said also another way to do this is via commodity currencies. So, for example, the Aussie dollar is very strongly linked to commodity prices, particularly the ones which Australia produces, a lot of iron ore, for example, which it sells to China. So that's another way to get exposure via the commodity currencies, but it's kind of indirect. There's another question from Akash Janils who says, is it worth paying for active management for a commodity focused fund? A lot of the problems with active management apply whatever the sector and whatever the kind of macroeconomic environment, and that is that most of them fail to outperform. So that's the problem with active management, and it's not any different in the energy sector or any other sector as far as I'm aware. So that's why I'd probably avoid active management myself. I'd probably just buy the entire sector. If you buy into this thesis based on your own research, that's probably the way I'd get exposure. Personally, I mean, I just don't trust active management myself. But if you have faith in a manager, you know that their track record's very good, their expertise in this sector's unsurpassed, then perhaps for you, if you've got the faith in that manager, it would be worthwhile doing it that way. Yeah, if you want to go the equity route. Owen says, which will have more potential, gold or silver? Okay, good question. Well, I mean, tactically, if you look at the model we've created for gold and silver, the one which is clearly well away from its fair value based on real interest rates and the dollar's strength that we can see at the moment is gold. Gold's more than 20% below its fair value according to that very simple model. But I wouldn't put too much faith into that model because it is just a very rough sketch of where the price of gold should be. And silver, on the other hand, is roughly at fair value. So personally, I think based on that, gold's got more upside tactically over a short period of time. Obviously, as a hedge, gold is typically better than silver. So if you go back to 2008, gold was much better store of value than silver during that big sell-off, for example. It wasn't great in March, I've got to say, compared to bonds, but gold is probably the better hedge if that's one of the reasons why you're buying gold. And that way as well, you know, if equities don't have a great year, then, you know, the gold at least would act as a kind of partial hedge for your portfolio. Brian says, do you see one last deleveraging of debt to bring commodities much lower before going higher again? It's very difficult to see that at the moment. What's interesting at the moment is that we've seen a huge flurry of debt issuance. So instead of seeing a deleveraging, we saw massive releveraging in Q3 of last year. When the Fed started buying bonds, that pushed interest rates lower in the US, it tightened credit spreads, and we saw a massive debt issuance binge in the US and elsewhere. So what we've actually seen is an increase in corporate leverage. The question now is, what are companies going to do with the cash? And I think that's actually another bull case for CapEx. because if they do get greater demand as we come out of lockdown, then they can spend that cash on infrastructure and on capex, and that would be positive. I mean, if it's a capital intensive company rather than a tech company, then that would be positive for a lot of commodities. So yeah, I think deleveraging certainly now is unlikely. I guess what you're hinting at, Brian, is that we could see a sell-off in equity markets if we get a deleverage, a forced deleverage. But again, it's hard to see the trigger for that at the moment, because it does look like things are improving and we haven't had any kind of credit hiccup, which could have happened going into the crisis. But who knows? I mean, that could happen. You could be right. Talbot Sunbeamer, hello. Nice to hear from you.
Together then.
2 questions.
Well, I think one's just an addendum.
The discussion of poorer people consuming more commodities is good, but is there great stimulus outside the USA? Lots of check talk to US citizens, but not much in Europe and Asia. Okay, so there's one question there which is like direct checks. So yes, we haven't had that in the UK as such, but we have had furlough schemes. Who is it that's benefited from the furlough schemes? Again, it's been the service sector which has benefited most, and those are the poorest in society. So it's not a check for nothing, it's a check to keep your job. And that's why we also haven't seen unemployment rocket in the UK and in Europe, for example, because of that program, which was funded by the government, of course, through debt issuance. So there's still a stimulus, it's just not in the form of a check. That's my point. And then the other form of stimulus is going to be the rebuilding of infrastructure, and that also will probably benefit people at the kind of lower end of the kind of socioeconomic scale and the wealth scale. Talbot Sunbeamer says, talking about spending money which lands in your bank. Yeah. I mean that's why it's the same. Oh, Leonard Nebel-Schutz, thank you very much. Thank you for saying thank you. I appreciate it. That means a lot to us. And right, there was another question actually, which was about what is a commodity swap ETF? Is that different to the enhanced one you just mentioned? So these commodity swap ETFs, the idea is that instead of going out and buying futures contracts, the fund manager would enter into a total return swap with an investment bank, for example, where they'd pay or receive payments as if they actually owned the physical commodity. So that's why that's another way of structuring one of these synthetic exchange traded funds. The danger of that is that it depends on derivatives, which means you also depend on counterparty risk. So let's say, just hypothetically, that the total return swap was with Deutsche Bank. If Deutsche Bank's credit quality started to look questionable, and I'm not saying that's the case, if it did, that would push down the value of the product, even though the price of the commodity hadn't gone down. So that's the risk with exchange traded commodities, which are synthetic, if there is a derivative embedded inside it. So just be aware of that. Whereas a physically managed, a physical ETF or exchange traded product like Gold One or silver actually goes out and stores gold or silver as you buy. So it is physically backed. So if the company went bust, then there's very little risk to you. They can just sell the gold and give you the money. Okay. Brian Fuller says, projected increased green tech. Is there a speculation boom in battery metal techs like lithium, cobalt, copper, graphite, nickel? Are there any ways to get a basket exposure to green commodities? That's a great question, and I don't know the answer. I just look in those ETFs that you've already seen to see whether that's the case. So remember that I showed you 2 links, one on Just ETF and one on ETFDB if you're based in the United States. You can go to those and see whether there is such a fund. I'm not aware of one. If there is one, tell me about it, because I'd love to know. That would be quite Interesting. Great. So shall I go back to the questions then?
Yes, something you need to thank. I just put.
Oh, right. Another thank. Was that Brian Fuller? Oh, Dee Dee. Dee Dee. Thank you very much. That's very kind of you. Thank you. That's very kind.
I'm trying to find some.
James Foster just said Guinness Sustainable Energy. Is that the is that one of the ones that buys commodities linked to sustainable energy? Is that what you meant, James? Okay, and there is a ticker for lithium, John Calloway says. The ticker is LITUS ETF. Good to know. So I think for some of these individual commodities, maybe cobalt, for example, you could get, certainly for lithium here, you can see there is a specific ET exchange traded product. And there's a question from... oh, and there's another one here that someone's mentioning, which is Vanek Vectors Agribusiness ETF. Okay. James Foster says, I'm steering clear of oil and mining funds. I'm in the Guinness Sustainable Energy Fund. Is serious about zero carbon and the Paris Agreement, including the US now. Yes, that's a good point. And in fact, if you look at the performance of some of these green energy funds, particularly the ones in the US, they have been spectacular over the last 4 or 5 months, or even longer. They have been performing very well already. Okay, so Tom Howard says there's a BlackRock ETF for clean energy. True, that's one of these thematic ETFs. One point I didn't mention, which is kind of important, is that many of these commodity ETFs, exchange traded products, are you pay around 0.45 or 0.5 management fee for them. Just be aware of that. Perhaps that's because of the way they're structured, or because there's not a lot of interest in those compared to something like an S&P tracker. But just be aware that you'll be paying more in fees. Okay, there's ICLN, according to Tom Howard, which is another clean energy fund. Thank you, Tom, for sharing that. So let's just scroll back a little bit and get some more of these questions.
I posted a couple in Slack.
Oh, lovely. Okay, Akash Jani says, would allocating a portion of a bond portfolio to TIPS be a better risk-adjusted way of hedging this risk from a commodity supercycle? Really interesting question. Now, bear in mind that the TIPS, the Treasury Inflation Protected Securities, would be linked to the consumption basket. In other words, a typical US consumer's cost of living. Now, that's not directly affected by commodities. In fact, if you look at the cost of living in the US, because it's a service-driven economy, most of what you pay for is the cost of people. So in other words, cost of labor. So for example, if you buy McDonald's in the United States, most of the money that you pay, or a lot of the money that you pay, will be the pay for the staff who both produce the burger, but also the people who work in the production of the beef, who bake the bread, and so on. So commodities are a less important part of the consumption basket in developed markets. In emerging markets, I think your argument's a good one. So if you did want to keep away, or if you wanted to hedge commodity inflation, you'd go for an inflation-linked bond in emerging markets, because there the consumption basket is much more driven by commodities, and in particular food. So in developed markets, I think it's not such a great hedge for commodity inflation. But if you wanted to benefit from a commodity price increase, there are these funds which give you a broad basket of commodities in case you don't know which one's going to increase. So you can diversify your commodity exposure that way.
Say thank you.
Thank you, Ivan. Thank you very much. That's really kind of you. Thank you for the £5 you gave us. That's really kind of you. We appreciate it. We do depend on you for our support, so so that'll certainly help us a lot. Thank you. MNF Chen says, would there be a commodity supercycle story for carbon credit as well? Yeah, I mean, this carbon credit market, there was a lot of hope that that would be a great way to trade carbon credits, but it's kind of fallen into out of favour, I think, because I think there was some trouble. There was a bit of trouble with the way it was set up. I think a lot of people didn't like it. So environmentalists in particular didn't like that carbon trading system. So I'm certainly not an expert in that. I certainly couldn't comment on it. But what I have read about it, I don't think that would be a direct way to benefit from something like this super cycle. I think it would be much simpler simply to go for one of the physical commodity funds or one of the synthetic ones in order to benefit from a boost in commodity prices, or potentially go for the equities, which would benefit for the particular sector, for miners or for energy producers, for example. That might be a better way to monetize it. Julian Van Kapellen says, I'm looking for a commodity ETF with Chinese companies. Any suggestions? Well, I'm sure they must exist because of the fact that China's so commodity dependent. I'm not aware of a particular one, but if you look at those two links, which I'll put in the description, which were in the presentation, you'll see that you may find some of those there, but I'm not aware of any. I'm sorry. That would be a good ETF to have, wouldn't it? That's an interesting one. How are we doing for time? Oh, we're coming up to an hour now, so I think we should maybe call it a day.
Yeah.
Yeah.
I want my ice cream.
Oh, Laura wants her ice cream, so it's time for time for us to draw this to a close. But thank you all for joining us. It's been great to have you on the call, live stream, I should call it. Apparently that dates me. So thank you all for joining us. Remember, you can always join our community. So go to patreon.com/pensioncraft. We write a weekly newsletter that's free on our website, pensioncraft.com. You'll find the newsletter there. And you can always have a power hour with me, one-to-one, to discuss any of your kind of investment concerns. I don't give advice, but you can use me as a sounding board to look at your portfolio or to discuss investments, how to manage risk, all of that good stuff. So thank you all for joining us. It's been great to have you on the live stream, and we'll be publishing a video as normal this week on Saturday, and we'll see you in a week's time, I think.
Week on Thursday.
A week on Thursday. Brilliant. So almost right. Brilliant. Thank you all, and have a great week. Bye-bye.